Why does IFRS 16 still confuse accountants, even years after it became mandatory? It's not because the standard is unclear, it's because most explanations focus on mechanics, not on what IFRS 16 is actually trying to change. In this video, I'll walk you through IFRS 16 in a way that makes the logic clear so the numbers finally make sense. The topics we are going to discuss is about what IFRS 16 is actually trying to fix, the problem, scope and practical exemptions, identification of a lease, lessee accounting, subsequent measurement, lessor accounting, sell and lease back. No shortcuts, no exam tricks, just the standard explained properly. Section 1. What IFRS 16 is trying to fix. The problem. Before IFRS 16, two companies with identical lease commitments could present very different balance sheets. One company bought its assets, the other leased them. Economically, both had long term obligations. Accounting wise, one showed debt. That created credibility problem. Analysts knew lease commitments existed, but they were buried in the notes. IFRS 16 did not change the economics of leasing, it changed how honestly those economics are presented. The core idea is simple. If you control the use of asset and are committed to paying for it, that rights and that obligation should be visible. Section 2. Scope and practical exemptions. IFRS 16 applies broadly, but not everything that looks like a lease falls within its scope. There are mandatory exclusions where other IFRS standards already govern the accounting, and IFRS 16 deliberately steps aside. For example, leases related to exploration or use of mineral oils and natural gas are excluded. Certain biological asset service concession arrangements and some licensing agreements are also outside the scope. In those cases, IFRS 16 does not apply because another standard already captures the underlying economics. Separately from scope exclusions, IFRS 16 provides two optional exemptions to reduce administrative burden for leases. The first is short term leases, meaning leases of 12 months or less with no purchase option applied consistently by class of asset. The second is low value asset assessed based on the value of the underlying asset when new and just lease by lease. These exemptions simplify reporting. They do not change the core principle or recognizing control and obligation. Section 3. Identifying a lease, the core decision. Everything in IFRS 16 depends on one decision made at the start. Does the contract contain a lease? To answer that, there are three questions. First is there an identified asset? Second, does the customer control the use of that asset? Third, is that consideration for a period of time in exchange of consideration? Most confusion arises around substitution rights and cancellation clause. If a supplier has a theoretical right to substitute an asset but no practical ability or economic incentive to do so, the asset is still identified. Similarly, cancellation or break options do not automatically prevent a lease from existing. The key point is this: control is assessed based on economic substance, not legal wording. If the customer directs how and for what purpose the asset is used, IFRS 16 treats that as control. Section 4. Lessee accounting, logic before numbers. Once a lease is identified, IFRS 16 treats it as two things happening at the same time. The lessee obtains right to use an asset, and the lessee incurs an obligation to make payments. That is why two balances are recognized at commencement: a right of use asset representing the economic benefit obtained, and a lease liability representing an obligation to pay. The lease liability is measured at the present value of future lease payments. discounted using either the interest rate implicit in the lease or the lessee's incremental borrowing rate. The right of use asset generally equal the lease liability, adjusted for items such as prepayment or initial direct cost. This approach mirrors how finance purchases have always been accounted for. IFRS 16 simply applies that logic consistently to leases. Section 5, Subsequent Measurement and Reassessment. At commencement, lease measurement are based on assumption, but those assumptions do not remain static. The right of use asset is depreciated over the lease term, reflecting consumption of that right. The lease liability increases with interest and decreases as payments are made. Importantly, IFRS 16 requires reassessment when certain changes occur. These include changes in lease term, modifications to the contract, or payments linked to an index or rate. This means IFRS 16 is not a set and forget standard, it is designed to respond to changes in economic reality. Section 6, Lessor Accounting. For lessors, IFRS 16 introduced very limited change. Leases are still classified as either finance leases or operating lease, based on whether substantially all risks and reward of the ownership are transferred. In a finance lease, the lessor recognizes a lease receivable. In an operating lease, the lessor continues to recognize the underlying asset and rental income. This creates a symmetry where both parties may recognize an asset related to the same physical item. That asymmetry is intentional. IFRS 16 was written to address a transparency issue on the lessee side, not redefine lessor's economics. Section 7, Sale and Leaseback. A sale and leaseback transaction must be analyzed in a specific order. The first question is whether the transfer of all assets qualify as a sale under IFRS 15. Only if it qualifies as a sale does IFRS 16 apply to the leaseback. In that case, the seller recognizes a right of use asset based on the portion of assets retained. If the transfer does not qualify as a sale, the transaction is treated as a financing arrangement. The asset remains on the seller's balance sheet. The sequence does matter. This is a revenue recognition assessment before it becomes a lease accounting issue. Now, why does IFRS 16 matters? It matters because leasing is embedded across modern businesses. Property, equipment, logistics, and long-term service arrangements all rely on leases. Once the underlying logic is understood, IFRS 16 stops feeling arbitrary. It becomes a consistent way of showing control, obligation, and economic reality. You now understand what IFRS 16 is trying to achieve and how its core decisions work. But IFRS standards do not operate in isolation. To continue learning using the same clear, principle based approach, watch the next video linked on the screen.